What's up guys, my name is Angelo. As we approach the new year, we have to talk about an important topic that's becoming more and more relevant lately. I'm of course talking about inflation, which keeps eating away at our purchasing power year after year. Inflation has always been something to keep in mind, but it's now reaching levels we have never seen since the introduction of the euro. And due to the excessive money printing since March 2020, the real rate of inflation is likely a lot higher than what is officially reported by the ECB. I mean, just look at how much the prices of assets like real estate or stocks have gone up since then. That's why it's more important than ever to not have your entire savings just sitting in your bank account in cash, as you risk losing a large chunk of your purchasing power over the next couple of years. So after realizing that inflation is on the rise and may remain high in the foreseeable future, what can we do to protect our savings? Well, I've been thinking about this topic a lot over the past 2 years, and it definitely influenced my investment strategy. So that's exactly what I want to talk about today. Before we get into it, don't forget to smash the like button if you enjoy videos like this. And if you'd like to support me and check out anything that I mentioned in the video, you can find all the links in the description below. Also, please don't forget that none of this is investment advice, just my own opinion based on my own experience as an investor. So, how high is inflation really? According to Eurostat, the official annual inflation rate reached a record high of 4.9% in the euro area, with some countries like Lithuania seeing inflation numbers as high as 9.3% compared to 1 year ago. Also, the way official inflation numbers are calculated leave a lot to be desired. For example, housing, electricity and gas prices only make up 17.7% of their inflation calculations. With people earning an average of 14,000 euros per year after taxes in the EU, or 1,166 euros per month, does it seem realistic the average person only spends 17.7%, meaning 206 euros per month on housing, electricity and gas? I find that very unlikely. Okay, my wife and I do, but we're definitely outliers and we got very lucky with how little we have to pay in rent for our apartment. What I'm trying to say, I think we can all agree that housing should have 2 to 3 times the weight it has right now in inflation calculations, not just 17%. I also find it kind of crazy what has been happening to electricity and gas prices lately. You might have noticed this as well when looking at your own bills. Here's the price chart my electricity provider sent me last week. The price of electricity has gone up 145% year over year and gas 150%. This almost looks like a parabolic Bitcoin chart. Of course, there are several reasons, like the higher carbon pricing set by the EU as well as supply and demand, but inflation is certainly an important factor as well, pushing the price of resources upwards. The takeaway is that your real rate of inflation depends on what you spend most of your money on. And since the ECB is still increasing the money supply at an alarming rate, real inflation is likely to remain higher than usual. I would actually be interested to know in the comments below where you noticed inflation the most in your own expenses. Okay, now that we're all depressed after the first part of this video, what can we actually do to protect our savings? Clearly, bank deposits and savings accounts aren't a viable option anymore since they pay close to zero in interest. Some banks even started charging interest to depositors. What a crazy world we live in. It seems like the only option that remains is to invest our money into assets that have a good probability of increasing in value over time or that pay a decent interest rate. Of course, none of these are risk-free. We all have to accept that there are no risk-free returns. If you hear somebody promising you anything like that, they're likely trying to scam you and you better run. However, I would argue that holding cash isn't risk-free either, as you're guaranteed to lose out against inflation over time. So here are the 3 investments my wife and I chose. Our hope is that these won't only help us beat inflation, but also grow our wealth long term and allow us to retire early if we so choose. The first and by far largest pillar of our long-term investment strategy are stocks in the form of ETFs, which is short for exchange-traded funds. Our ETFs passively track a global stock market index and they make up around 60% of our portfolio. We like to keep this part as simple as possible. It's very difficult to beat the market as a whole long term. A lot of much smarter people than me have tried and failed miserably over a long enough time horizon, so I won't even try to waste any time on it. The ETF we buy on a monthly basis is the Vanguard FTSE All World. Via a single low-cost ETF, we're able to invest into over 3,600 companies from the entire world. We're not placing bets by buying single stocks of companies which could always go bankrupt and cost us our entire investment. Instead, we're counting on the world economy to keep growing over time, as it has for the past hundreds of years or more. Nobody can tell you if Apple, Microsoft or Google will be this relevant in a decade or more, or if they'll be replaced by other more profitable businesses. And who knows if the US will continue leading the market, or if more and more successful companies will be based in China, India, or one can hope maybe even Europe. And if companies continue to automate more work via AI and machines, we want to earn our fair share of that increased profitability as well. By the way, I'll link some useful videos about ETFs and my favorite brokers in the description below. So let's get back to the topic of inflation. In the past, stocks have been a great long-term hedge against inflation or even periods of hyperinflation, as was the case during the Weimar Republic in Germany between 1920 and 1924. Within only 4 years, 500 marks in the stock market were worth close to 100 billion marks, while cash basically lost its entire value. Just to clarify, I think it's very unlikely we'll ever see hyperinflation with the euro or the US dollar, but I still think it's worth thinking about whether or not you have some protection against a tiny possibility. Now, if you're new to stocks or ETFs, you need to understand that the market is volatile. Prices don't only go up, they also drop on a regular basis. I'll use the MSCI All Country World Index as an example, which is very close to the FTSE All World Index we invest in, but has more available data. Since December 31st, 1987, this index averaged an impressive 8.47% return per year. But this average came with a lot of ups and downs. For example, in 2008, during the last financial crisis, the index was down 41.85%. Maybe now you understand why I keep telling you to treat ETFs as a long-term investment. I'm expecting average returns of about 7% per year with a lot of ups and downs. Also, as a rule of thumb, time in the market beats timing the market. Nobody can successfully predict what the market is going to do. I just keep investing on a regular basis, and if there's a correction, I treat it as a discount opportunity where I can buy more at a cheaper price. A friend of mine from Germany felt really smart when he sold all of his stocks in the beginning of February 2020 when the virus was emerging in China. He correctly assumed it was going to impact the world economy. But here's the problem. He kept waiting for the market to drop further and is still waiting in cash on the sidelines uninvested. He missed out on a 33% return because of his decision. To make things worse, because he sold, he already had to tax his previous profits already, instead of in retirement, for example, which means he now has less money left over to get back into the ETF at a much higher price. Taxes are another reason I believe simple buy and hold investing via ETFs makes the most sense long term. The second pillar of my investment strategy is peer-to-peer lending, which, let's be honest, is not surprising since this channel is called Peer-to-Peer Investing Europe. My wife and I have about 15% of our portfolio invested on different peer-to-peer lending platforms. These currently earn an average of about 10% interest per year, which should be enough to beat inflation. Peer-to-peer lending is a very unique asset class, especially for anyone that prefers receiving monthly cash flow from their investments. That's something that could be especially useful if you're already retired, for example. Another advantage is that it has little correlation to other assets like stocks or real estate. So a stock market crash or correction doesn't really impact the performance of peer-to-peer loans. And in that situation, you could even use the cash flow you receive from peer-to-peer lending to buy stocks or ETFs at a discount, which is exactly what my good friend Bernard Hummel did last year in March. Still, last year was a great lesson for me and many other investors in the space to stick to transparent platforms and lending companies with a profitable business model, which they can prove via audited financial statements. You can see my personal top 5 as well as my auto invest settings for each in this video I recorded a few weeks ago. The loan durations I invest in vary from platform to platform and can range between a few days and a few years. If you need your money to be accessible right away and you're okay with earning a slightly lower yield, in my opinion the best option for that is Modora Go and Grow. Go and Grow automatically spreads your investment over a basket of several thousand individual loans from Estonia, Finland and Spain, and pays 6.75% interest per year. The best part is the interest is added to your account on a daily basis and you can withdraw your money at any time under normal market conditions. The only thing you need to keep in mind is that there is a €1 withdrawal fee. And that brings me to the third and last pillar of our investment strategy, crypto. About 10% of our portfolio is mostly invested in the two largest crypto assets, Bitcoin and Ethereum. Look, maybe it's because I'm 31 years old and I grew up with the internet, but I see Bitcoin as an alternative to owning gold and as a hedge against inflation. I also consider it a small insurance policy against extreme unforeseen political or economic events. Of course, Bitcoin has a much shorter history than gold as a store of wealth, but it also has a lot more upside potential and it's mathematically limited in supply. And yes, the potential upside also comes with a lot more risk, but it's a bet I'm personally willing to take with a small part of my portfolio. I also never found buying gold to be practical. You either have to buy it physically and then store it safely so it won't be stolen, or you have to trust a third party via an exchange-traded commodity, for example. To me, Bitcoin is a lot easier to handle and it's easily divisible, which gold isn't. Not only that, this environment should have been perfect for gold as an inflation hedge, and yet, when looking at the charts, it's still below its 2011 price. Meanwhile, even though it's currently also sitting below its all-time high, Bitcoin has been doing a lot better throughout the past 2 years. And let's not even talk about the second largest crypto asset, Ethereum, which has been outperforming almost everything else over the past year. It does seem as though some investors who would have previously purchased gold as a hedge are now choosing Bitcoin as well as other promising crypto assets as an inflation hedge for part of their wealth. That could also explain gold's lackluster performance and why the trend could continue in the future. Then again, I could just as well be wrong, this is just my opinion. The 10% of our assets I invested has now grown to a lot more, even though I already took out my initial investment a while back. Due to how volatile this space is, I'm currently debating how much and how often to rebalance my portfolio. I also don't track this part as closely as our investments in ETFs and peer-to-peer lending. Now, if you're starting from scratch today, how much you allocate to this sector is completely up to your own personal preference and risk tolerance. But I wouldn't go beyond 10% of your portfolio. I actually think 1 to 5% is plenty for most people. Personally, I would then split most of that between Bitcoin and Ethereum, the two largest cryptocurrencies. It's up to you if you also want to mix in a small percentage of other blockchains you may find promising, like Solana, AVAX or Luna, for example. I personally stay away from pure meme-based coins like Dogecoin, Shiba and the likes with no real use case. I would also pay attention to use a reputable exchange like Bitpanda, Binance, FTX or Kraken. I'll link those down below. Just please make sure you're securing your accounts with strong unique passwords and activate two-factor authentication right away. And once you own a couple thousand euros or more worth of cryptocurrencies, it's probably a good idea to spend $60 on a hardware wallet for an extra layer of security, as it allows you to store your crypto offline. If you want to learn more about everything related to crypto, I think Coin Bureau is probably the best channel out there. He certainly does a much better job at explaining any of this than I do. So now you know the 3 asset classes my wife and I use to try and beat inflation and grow our nest egg long term. In case you paid attention to the percentages I mentioned, you're probably wondering about the remaining 15%. Well, a good chunk of that is stuck in our apartment until we one day move out, as well as on our bank accounts in euros and a bit of US dollars for some extra diversification. Since I'm self-employed, sadly I need to keep a larger cash buffer to prepay social insurance and taxes here in Austria, but I'm hoping to decrease that position over time. What are you doing to protect against inflation? Is this something you're even thinking about? I would love to know in the comments. Before you take off, if you enjoyed the video, don't forget to smash the like button and to subscribe to see more. Also, if you'd like to support me and check out anything that I mentioned in the video, you can find all the links in the description below. Thank you guys so much for watching, and until next time.